Welcome traders. Now today we're going to be diving into the first episode of the Wolfpack free YouTube trading course, and this episode is going to be focused on what new unprofitable and break-even traders should be doing and what processes they should be going through to start generating consistent profits in the markets. Now this course is beginner friendly, so whether you have no experience or you're an experienced trader, if you fit within the category of new, unprofitable or break even, this course is for you. So strap yourselves in and let's get right into this. So in today's video there are 9 points that I think the new break even and unprofitable traders should be focusing on, and that is the kid in the candy shop, liquidity pool theory, high probability liquidity, the ICT fair value gap and order block, high accuracy and low drawdown entries, benefits of scaling profit, 100% of partials pay, focusing on the winning week, 20 to 30 pips, the devil and the angel emotion, and then process not destination. So let's jump straight into this. So today the first technical point that we're going to jump into is liquidity pool theory. Now, as you may or may not know, liquidity rests above old highs and below old lows. Now in this depiction that I'm showing here, below old lows we have sell side liquidity, above old highs we have buy side liquidity. Now the reason we have to view these areas as liquidity is because smart money needs liquidity to offset their positions with. So if they're in a sell position, they need to offset their selling positions with sell side liquidity, and if they're in a buy position, they need to offset their buy position, basically taking profits, with buy side liquidity. Now as you've seen here, this is just one singular low on its own, so that would be an old high, and this would be a singular old low. Below here we have equal lows. Now retail minded traders will see this as a support area, so there will be large amount of liquidity built up, sell side liquidity built up below these old lows in the form of sell stops, as people who are buying will put a protective stop loss below these lows, so that generates a liquidity pool. Now through the lens of smart money, this algorithm and the way that it delivers price is constantly seeking liquidity to basically generate profit. So if we start to see old highs and old lows through the lens of liquidity, we can start to accurately anticipate where the market's heading to next. Now as you may have distinguished, I've got just $1 sign above these old highs and below these old lows, and here there is more resting liquidity above these equal highs, and you can get relatively equal highs, so like this and like this. This is completely valid as well. These are called relative equal highs. These are equal lows exactly. So we're going to look to target out of these two. Which one would you rather target? You would rather target the equal highs and the equal lows, because these areas will be viewed through the retail mindset as a protected area, as support. You will often see retail traders draw support here and resistance above here, and I'm sure yourself you may have done this as well. So these areas will be viewed as support and resistance, and the retail mind will see price coming up to here. Let's say it comes up to here and then gets resisted lower, and then comes to here and then gets supported higher. Whereas the way that we're going to view the market, we're looking for price to come higher into an area of premium, take out these liquidity pools below here, and then we have counterparty liquidity to then target the equal highs. So that is basically what the algorithm will do, and you will see it constantly doing, as it is seeking out counterparty liquidity to offset and profit from the positions of smart money. So the next technical I'm going to go through today is the bullish and bearish order block, which is classified as a change in the state of delivery. So as you can see in this bullish order block example, price is approaching the sell side liquidity, then here price closes way above this opening price and the high of this order block, after taking the sell side liquidity resting below. Now once we get a close above here, we've changed the state of delivery from offering a sell program into a buying program. And if you want to enhance this even more, you want to see a displacement in this leg with an FVG left here, and then this shows there's a willingness to change the state of delivery with displacement. And then once we revisit the opening price, by definition the whole range is what you want to be aware of, but that opening price is where you see the change in the state of delivery. So here we've got the bullish example, and as you can see we seek out the buy side liquidity afterwards. And with the bullish order blocks, it is the down close candles supporting up price. Now in the bearish order block example, we see price here approaching the buy side liquidity, these relative equal highs. In the same instance, these relative equal lows got raided here. Price pushes above, and then price here closes below this opening price, changing the state of delivery from being in a buy program to being in a sell program. And now bearish order blocks are up close candles, and again, if you want to enhance this, once we get a close below this candle's low here, you want to see an FVG left in this leg of price. So we're seeing a willingness for price to displace lower after changing the state of delivery, raiding the buy side liquidity. So the order of operation now is for price to seek out the sell side liquidity resting below this old low over here. So hopefully that has given you some clarity with order blocks and how to use them, and in the bearish and bullish scenarios. So the last technical PD array that I will be going over today is the fair value gap. Now on the left hand side you can see we have the SIBI example where we have a sell side imbalance, buy side inefficiency. So this black candle was inefficient at delivering buy side from this candle's low to this candle's high. So this whole portion that's shaded red is our fair value gap. Now if we continued bearishness and price returns to this fair value gap, we can see continued selling off from this area. And on the same merits for the BIS example, this candle was inefficient at delivering sell side delivery, only delivering buy side from this candle's high to this candle's low, creating our BISI fair value gap, which is this blue shaded area. And if we are continuing bullish, then once price returns, we can see price continue from these types of areas. Now I know a lot of you are ICT traders in here, and a lot of you will be thinking, well, why are you going over the basics? But you will be surprised how many people get fair value gaps and order blocks confused. Now these two paired together, the order block and the fair value gap, are extremely powerful, and it is probably the only two PD arrays, if you wanted to learn and only stick with those two, that you could be profitable with. So that's why I'm teaching them today, to just clarify anything that was misconstrued in your own mind. So yeah, let's jump into some charts. So right now I want you to look at this fractal of price on euro US dollar on the 15-minute. And yes, I'm aware this is a range. I just want to demonstrate the relationship between old highs and old lows, liquidity and fair value gaps and order blocks, and how we can use these orders of operation of price to effectively establish what price is likely to do next. Now I want you to pause the video here, look at which equal highs, old lows had a function in price and what was birthed in those liquidity pools. Now if you don't pause this video here and have a look for yourself, then this is just a waste of time of an exercise. So just have a look. Even if you're wrong, that's okay. Just pause the video and then I'm going to show you all the key areas in this fractal of price. So hopefully for those of you who haven't been corrupted by retail logic, and you're following everything that I'm saying in this video, these are some of the areas that you will have got noted. I doubt you would have got every single one, and there are more on here that I haven't got noted, but I don't want the chart to be too busy. So we have, going through the story of price, we have this push up, comes back down, fails to take this, creating a failure swing, which is a relative equal low. Then price fails to come up here, making another failure swing, so we have equal highs. Price breaks down to these equal lows, consolidates, gathering liquidity, does one final little raid here, pushes to the upside, and then price generates equal highs here. It's a little push from this candle above, but that is still an equal high, and then we break lower. This fair value gap has a small consolidation, but notice at this fair value gap, no body ever closes above the discount low of this fair value gap. So the discount low would be here. This is the discount low. Notice no body closes in that discount low, above that discount low of that fair value gap. The same way on a bearish scenario, if no body closes in the premium high, you can safely assume that all these wicks are just gathering liquidity to seek what? This intermediate term low down here. Then again, we break lower, come into this fair value gap, and then we have our order block. After we raid this sell side liquidity, we change the state of the delivery. Now we use this opening price here on this candle, price dig backs into it, so price digs into an order block with this order block right here, which creates a propulsion block. Now a propulsion block is a high accuracy and low drawdown entry. Propulsion blocks is basically, we have the order block that raided sell side, then another order block digs into the previous order block, fair value gap in here, and then what happens, this next candle changes the state of delivery. So after this candle closes above this opening price and this high, we've changed from offering sell side to delivering buy side. We've already taken all the resting liquidity below here, failed to break once more, and then changed the state of delivery from sell side delivery into a bullish order block, this area, and now we've shown displacement with this fair value gap and propulsion block that we want to go higher. So on the list, when I said about high accuracy and low drawdown entries, propulsion blocks are exactly that. Combine it with a fair value gap like this, which is displacement to the upside, changing the state of delivery, then you can start to take an entry right here at this candle's low. Now where would your stop go in this case? It would go below this candle's low right here, this swing low, and then where you would target is equal highs and later on this fair value gap. So that gives potential for a 1 to 2.56, which is really nice RR when you're starting out. So once you've established that the change of the state of delivery is happening after you've raided sell side liquidity, and then we get a propulsion block. Now with propulsion blocks, this is a bit of source that will probably go over a lot of your heads, and a lot of people will not watch the video long enough to capitalize on this information. But propulsion blocks are one of the PD arrays that we can expect immediate response from. Now what does that exactly mean? So that means after the propulsion blocks formed here, once this candle taps, we get 2 intervals of time of the time frame of the propulsion block is on. So this is on the 15-minute, so we give it 2 15-minute candles after that, and if we are not showing signs that our idea is right, so say price after 2 15-minute candles, one closed here, the next closed here, you can cut your trade at an early loss and then not take the full loss, and this will smooth out your equity curve over time. And that will basically mean that you can stay in the game for longer, and mean passing challenges is easier because you're getting out of bad trades early and you're staying in the good trades. As you can see from this trade though, we get the tap, the next 2 candles, what do? the next two candles show us a sign and a willingness that we want to expand up into this liquidity pool and these equal highs up here. ICT, the guy who came up with all of these concepts as a whole and as a system, says that smooth edges will become jagged. So this smooth edge up here becomes a target for all of us who realize all the sell side. Look at all this sell side that's been taken out. Then we change the state of delivery here, dig into it one more time, show displacement to the upside, propulsion block, so we can wait for 2 candles to signal if we are bullish or not, and then we know we can hold this trade. So that is basically reading the liquidity pools, the fair value gaps, and the order blocks within this small range, and looking how price is, the relationship of price is coinciding with each other to attack liquidity pools. So as you can see down here, as we clean out this liquidity on the sell side, change the state of delivery here, dig in with a propulsion block, and then we get the perfect on the money entry, literally to the T, right on it, right there. So this candle's low comes in at 8822. This candle's opening price comes in at 8822, as you can see. I'll show better here. So up here we have the opening price, and then this is the low. Look at these 2 price points. So this candle's low here comes in at 8822, and then this candle's opening price, as you can see here, 8822. And now it doesn't get any more accurate than that, does it, folks? It doesn't become any more precise than that as well. So this entry right here would have been a 0 drawdown entry. So that is exactly how you find high accuracy and low drawdown entries. And then what we do, say we're managing this trade, we're sat in this trade right now, and we see price right here. So this is what we're expecting price from price. This is our final target, this fair value gap above the liquidity pool, and then we're looking for our entry at this opening price. So if we just fast forward price here, bang, we get an entry. So we wait 2 candles there. That's exactly, so these 2 candles, what we want to see. The fact that these candles are closing bullish after coming off a highly reactive PD array, which is the propulsion block, which is just an order block that is dug into a previous order block, we can safely assume that we want to hold this trade. Now the next candle, bang, that would be a partial. So that partial here will be a 1 to 1, 1 to 1.1, and we would take 50% of our trade off here. So we would have 0.5% banked if we risked 1% straight off the bat. So we'd already be up 0.5%. Now, once we've got this propulsion block showing reactivity straight away, and we've already banked our partial, we can use a smart little tool measuring from our entry to our target. And now, as you can see, for the beginner trader, this is easy to do. You anchor a fib tool from your entry to your stop loss and from your entry to your target. Now, as you can see here, this candle hits 50% of our target. So what that realistically means is our stop loss can be reduced by 50%. So our stop loss, new stop loss, would go here, just below this fair value gap and just above this rejection block here. But that's for later lessons talking about rejection blocks. So we've banked 0.5% here with a partial, and our risk is reduced by 50%. So we've got 0.25% risk on the table, and we've already banked 0.5%. So we cannot lose anymore. And this is how you smooth out your equity curve, by using partials, managing your stop loss with this trade system. And then you can accurately and efficiently smooth out that equity curve. A lot of the times with new traders, they'll have sharp, jagged equity curves that are going up and down, and their equity curve will look something like this. So if this is the new trader's equity curve, they're getting up and then big drops, and then they might go up and then lose loads of profit, come down, and then account blown down here. We don't want our equity curve to look like that, and this is how we do that. So using high accuracy entries and then managing the trade. High accuracy with low drawdown entries and manage the trade, and then using this trade management system, we can no longer lose. The market can only give us 0.25% profit. That is the only outcome that can happen now. The worst case scenario, we make 0.25% profit, and now when you manage your trades like this, your equity curve might take a couple of drops, but you see how over time it's a lot smoother. This kind of equity curve is something a lot better than what we previously saw without managing trades and just having a stop loss, where you've got a lot of jagged. Now can you see why we manage trades and use trade management systems to avoid blowing up accounts like this? And this is exactly how we do it. And now these trade management systems might annoy you at the start, because you might, for example, take your partial here and then get stopped out, and then it runs to take profit, but we've managed the trade so efficiently that we've won from what would be a normal losing trade for you or another trader. So this is going to smooth out your equity curve to look a lot more like this by managing your trades using this system here. So that's just a little gem that I didn't put on the task sheet, but for those of you who are sitting and watching, I want you to be able to effectively implement all these skills into your trading. So if we just keep playing price forward, we've already got our partial, and then price is in a range. Okay, we're working towards our profit target. So now we're out of hours, so this might be the point where you might cut your trade, or you could be the type of trader, so here you take your remaining profit off the table just before, let's say, 3:30 Eastern Standard Time. So this would be the point for an intraday trader where you've already banked profit, and then you close your trade out here all the way up until 4. But as you can see, the market's stagnant around here, and it usually will be. But for the traders who are willing to hold this through Asia session, which I wouldn't strictly advise, but this is just showing you how these smooth edges get attacked by price and how you could have held this trade through Asia. And then there, boom, we see it, that candle right there. So on the 22nd of July at 11:15 Eastern Standard Time, this smooth edge gets made jagged here, and it probes up into this fair value gap in the premium of this range, and then that would be your final take profit hit, and there would be a winning trade for you. Purely targeting smooth edges, because smooth edges will be made jagged in the future. So I hope that broke down high accuracy and low drawdown entries for you, the benefits of scaling profit, because 100% of partial profits pay, and managing multiple trades over and over, and keeping a good system in place to stop you being greedy, to stop you having jagged equity curve, and your equity curve can become a lot smoother like this in the future. So now we've gone through some of the technical side and what you actually want to be doing to profit from the market. Now I just want to talk a bit more psychologically about focusing on a winning week or the winning day. And now a lot of traders think they can just come into the market and become rich, and that is the case for a very select few who get lucky, but that doesn't usually result in sustained profit or consistency in income. So when you just start out and you get that winning day, please just allow yourself to have that winning day and have that winning week. Now, say you took this trade and you longed it from this propulsion block that I said, and you got out here, you got 14.3 pips profit. So 14.3 pips profit, and that is enough for the day. Your day should be done there. You take one win, you're done for the day, and if you take one loss, you're done for the day. Because really the only goal here is to preserve capital and allow yourself to have these winning weeks. 20 to 30 pips is all you need for the week when you're just starting out. Obviously, as you advance, you'll start to get that per trade, and maybe twice a week you'll get 20 to 30 pips. But even still, that is plenty profit to pass accounts, to quit your job in the long run, to build capital with these prop firms or own personal capital. If you could purely focus on getting 20 to 30 pips every week or averaged out across every week, then you would definitely be some of the elite traders in the industry. And a lot of times we'll get caught up trying to get the 100, 300, 400 pip runs over the week, but you really don't need that, nor is it worth the mental capital. So I really want you as a new trader to focus on having that winning day. So if you take a win, stop trading, give yourself that winning day, allow yourself to have that positive reinforcement from following a disciplined process. Once you win, you're done. Once you lose, you're done, and continue in that process. Because with trading, the emotions will kick in and they will try and grip hold of you. That devil is going to have a harder grip on your shoulder than any angel will be able to. A lot of the time, the devil will be saying, oh, go on, there's another setup, get in there. There's more opportunities. Why are you sat on your ass doing nothing? That's what the devil will be telling you to do. To keep looking through different markets. Oh, you've took a win on euro, what's gold doing? Let's scalp it. These are the emotional roller coasters that you will get when you've had those winning days. And it's the same on the losing days. On the losing days, the devil will be on your shoulder. Right, get in there again. You've got another chance. There's another setup. There's another asset that's going to provide today. Don't be sat there waiting. Whereas the more angelic approach would be to allow yourself to have the winning day. And most of the time, I would advise traders, say you got your first trade on a Tuesday. You don't trade Monday, you trade Tuesday. You get 20 pips on a Tuesday. My advice for that trader and that new developing trader is to avoid the rest of the week. Great, go onto a demo account. If you want to continue trading, go onto an account where no emotion has to be attached to you winning or losing. And if you want to press buttons and satisfy that need, then you're already seeing that you have an addiction to the dopamine that you get from trading. So I want you to really sit back and think, once you've had that winning day or that winning week, do I really need to keep pressing myself in the market today or this week? Because I've had a similar experience this week. I've took a winning trade on a Monday, buying NQ, and it's in my Telegram, my entries and executions. I will not trade the rest of the week. I know the state of the geopolitics and the economic state of the world with the Japanese yen carry trade and the stock market right now in America. So I understand, with all the riots going on in the UK, all the war in Iran and Israel, and all these other geopolitical tensions with Russia and Ukraine, England, the world is not giving you the ideal times to trade. So when you really do get that winning day or that winning week of 20 to 30 pips, focus on locking that in, and then you can write down in your journal, stuck to my rules, I've had a winning day or a winning week, and the devil on my shoulder was trying to get me into the markets again, and I politely brushed him away. And that will do you so much better than going, oh, let me just get on my demo account and press some buttons. Go and watch some educational content, go and learn a new skill, go and have a hobby, go and create a YouTube channel of your own to document your journey, and really focus on locking in those wins and not allowing yourself to revenge trade the wins, because some people will win and then keep pressing the edge and then blow all the profit and some and be in drawdown. That is what we want to eliminate. We want good conditions, we want good discipline and good patience. So if that means taking one win a week and being done for the week, that is what you must do, and that is what will generate you money. Our goal is not to be right every day and say, oh, we called the market, or yeah, we're in a winning trade every day. The goal is purely to make money in this. That is it. So get your head on straight, understand what our goal is here. All of our goal is to make money. That is the only goal. The only reason you clicked on this video as a beginning trader is to become profitable. So these are the processes you must adhere to, and if you can't adhere to it and you have to feed that addiction to trade, then you will never be consistent at this. I will tell you a story. So 2 weeks ago, I didn't take one trade. Then the week after that, I made 8% in a day on NQ. Do you think I would have been 8% up in those 2 weeks if for those 2 week periods I was trading every day? Best believe I would probably be down 8%, not up 8%. So that process of knowing I've got to wait for the market to come to me, wait for my edge to present itself, wait for the right conditions, and then effectively managing my emotion by reading the tape efficiently, like we were in here, reading the signatures in price, then all the emotion disappears and all of that need to trade disappears, because you understand that it's for the greater good of yourself and your account and your future and your development to just lock in the winning week and the winning day, and to avoid the shitty days. That is literally going to make you rich. So what interest do you have to sit and trade in here before you wait for that edge to present itself and wait for that narrative to build up beforehand, and allow yourself to have those winning days and those winning weeks locked in the bank, and you can really start to see progression, because you can be happy that you didn't break any rules and you didn't over leverage and you managed your trades effectively. And this links into the final point that I'm going to talk to you, and it's all about the process, not the destination. I'm sure you've all heard it, but the guy who loves to walk will walk more than the guy who loves the destination. And that is so true within trading, because if you love the process of waiting for your edge to appear, staying out of bad markets, pushing your edge when it's time in good conditions and it's presenting itself, managing your trades effectively, reading price to make your decisions rather than basing it off how you feel in the trade, and start to exercise outside the markets, eating cleaner. Okay, you don't have to eat, and I don't eat like a absolute angel, and I do eat poor meals sometimes, but if you're just consciously trying to make the effort to have better meals, drinking enough water, going out and exercising, getting 10,000 steps in, having hobbies, playing football, all breed great healthy living and great healthy trading. And as weird as that may sound, that whole process and the things you do outside of trading, say you take a loss and you set a rule, right, when I lose I must go out and run 2 kilometers, and that helps you clear your head, and that helps you reset and block out those emotions, and you put a practical task in place that makes you get away from the charts. that process will get you to the destination you want, rather than thinking about, oh, I want a Lamborghini, or oh, I want to retire my mom, and how am I going to make $10,000 a day, or how am I going to make $10,000 a month. That process behind will generate the outputs that you want, and the inputs will generate the outputs. It's no other way to put it simpler. So I really hope you can implement these lessons into your trading, and I really hope you can sit down and reflect on your own trading and your own lifestyle and really start to implement this. So have a good day, people. This video was insightful and you can implement these skills into your own trading. Please drop a like and subscribe, and I will catch you in the next video.